Economic entity assumption. This principle assumes that the business is a separate and distinct entity from its owners or other businesses. It requires that financial records of the entity are maintained separately from the personal finances of its owners or affiliated companies. Example, a business owner's personal car purchase should not be recorded in the company's books. Purpose, maintains clarity and avoids financial confusion. Monetary unit assumption. This principle states that all financial transactions should be recorded in a single, stable monetary unit, typically the national currency, e.g., US dollars for US-based companies. It also assumes that the purchasing power of money remains stable over time, ignoring inflation in basic financial statements. Example, a Nigerian company records a machine at 5 million Nigerian nairas without adjusting for future inflation. Limitation, ignores inflation/deflation, which may distort long-term values. Time period assumption. Also known as the periodicity assumption, this principle requires that a business's activities be reported in standardized time periods, monthly, quarterly, annually, regardless of the continuity of operations. Example, preparing income statements every 3 months, quarterly financial reporting. Purpose, enables performance comparison across periods. Cost principle, historical cost principle, states that assets should be recorded at their original purchase cost, not market value or appraised value. This cost remains on the books even if the asset's market value changes. Example, a building bought for $200,000 in 2010 remains recorded at $200,000, even if it's worth $600,000 today. Criticism, may understate or overstate true asset value over time. Full disclosure principle. This principle mandates that companies must disclose all information that could affect a reader's understanding of the financial statements, either within the statements or in accompanying notes. Example, lawsuits, pending tax investigations, contingent liabilities, and loan covenant restrictions. Importance, ensures transparency and protects stakeholders from hidden risks. Going concern assumption. Presumes that the business will continue to operate into the foreseeable future, and will not liquidate or cease operations. This assumption influences how assets and liabilities are valued and presented. Example, assets are not reported at liquidation value because the business isn't expected to shut down. Red flag, auditors must disclose if the going concern assumption is in doubt. Matching principle. Requires that expenses be recorded in the same period as the revenues they help generate, ensuring accurate measurement of net income. Example, salaries paid in January for work done in December should be recorded in December. Application, central to accrual accounting and income measurement. Revenue recognition principle. States that revenue should be recognized when it is earned, not necessarily when cash is received. This principle is now guided by ASC 606, which introduces a 5-step revenue recognition process. Example, a subscription service recognizes revenue monthly, even if the customer prepaid for a full year. Critical 4, subscription-based and multi-period services. Revenue recognition principle. States that revenue should be recognized when it is earned, not necessarily when cash is received. This principle is now guided by ASC 606, which introduces a 5-step revenue recognition process. Example, a subscription service recognizes revenue monthly, even if the customer prepaid for a full year. Critical 4, subscription-based and multi-period services.